Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically joining me today would be Michael Becker, but he is closing another loan today. That is the busiest guy I know. So in the podcast today, we have Alan Stewart. Alan and I have known each other for a number of years. We probably first met through Indian Princesses Between Our Daughters. That was a great father and daughter event. And then also, too, we go to the same church. So I've known Alan for a number of years. And through that period of time, I've seen Alan go from owning some real estate to owning lots of real estate. So we're going to talk a little bit to Alan today about a little bit of what his journey has been all about and kind of figure out what his game plan is, what his roadmap has been, and so that you can learn from Alan. So Alan, thanks for being on the podcast. I appreciate that.
Thanks, Paul. Appreciate it.
So Alan, tell me a little bit about your background. What do you do for a living? Where did you go to school and all those things?
Sure. So I went to Texas A&M, studied engineering. It was kind of funny, when I was looking at what I was going to do after I got out of school, all the jobs I looked at were actually a little bit more business focused than engineering. And so right out of school, I joined this place called Anderson Consulting, which became Accenture. So then I was there, a number of years, and then joined another management consultancy. And so sum total, in my 19th year of management consulting. And so what I've done with that is basically help large businesses implement either large business or technology initiatives and helped either architect them and or be kind of the program manager to help make them happen, and worked on projects anywhere from $250,000 to $100 million in scope.
That's a lot.
Yeah. There's a lot of moving parts sometimes.
So tell me about why real estate, why multifamily? How did you get into it? What was ringing your bell to make a position in apartments?
Sure. Yeah. Actually, it's gone back quite a few ways. It was like in the early 2000s, I went to a real estate conference that was put on here locally in the Dallas-Fort Worth area. And Robert Kiyosaki was there speaking, and he was talking about rental and real estate and passive income. And I was like, wow, that sounds, I get it. That's what I want to do. That makes sense. And so interestingly enough, I ended up getting a mentor that was a little more focused on residential wholesaling. And so did a turn at that for a few years. And, but I always had this bug in the back of my head of, well, I really wanted to do the rental real estate to get the passive income as opposed to kind of the transactions related to wholesaling.
What does that really mean? What does wholesaling mean?
Sure. Wholesaling can mean a lot of different things, but basically it's finding a way to creatively create value between a seller and a buyer. And so some of the things that we did, for example, is if somebody's having some trouble and they're going to go into, foreclosure, there's what's called a short sale. And so in a short sale situation, we can help the seller kind of get out of that bad situation and avoid foreclosure, and at the same time match them with a buyer and then help them through that transaction. So it's kind of creatively creating some value for both sides in the middle. Okay. And that's one example of wholesaling.
So you went from wholesaling and then got into rental real estate on single family side? So
interesting enough, I was looking around for mentor as it relates to rental real estate in single family. And so, I found one locally. And so I came in there and was looking, I was like, I'm going to buy 10 houses this year and, really go that path. And, we were talking about also the prospect of multifamily investment. And kind of from my business background, I was looking at that and I said, oh, well, that's very interesting because for a couple of reasons. One is it's really a business. It's valuated as a business. And so there's some control about if you run your business better, you can increase the value, as opposed to on the single family side where it's more the comparative market analysis of what's going on in the neighborhood. And so a little have more control there. And then, of course, it has commercial loans. And so all of that together was really attractive to me. And so I said, well, actually, I'm going to not buy those 10 houses and I want to go after some multifamily.
So walk me through that. So you decided not to buy the 10 houses and you decided to buy apartments right out of the box, or what did you do?
Yeah, I did. Actually, I was, met a couple of like-minded investors and, a small group of folks, and we were kind of looking at some different deals that were either listed by brokers, or I think we looked at one at auction.com. I think we actually put a bid in, as I recall, way back when. So in the end, just, networking and working, and, ultimately through that, the first multifamily investment I actually did, found another investor that they were putting together a deal where they were buying a 77 unit complex in Irving, Texas. And it was being purchased as a yield investment. So, meaning you're looking for it to, cash flow early on. And it had a Fannie Mae loan on it, so non-recourse financing. And so I actually invested in that as a passive investor in my first deal.
And what does that mean? Being a passive investor? What does that mean?
Sure. So as a passive investor, it basically means that you invest some capital in the deal, and for investing that capital, then you get a percentage of the owning entity that owns the apartment complex. And so you do that, and then the lead investor or deal sponsor is actually the asset manager and running the property, and there could be property management company also kind of running things day to day. And so they're running everything, and then as a passive investor on a monthly basis, you'll get your financial reports. So kind of take a look at those and see if you have some questions, learn in the process. In the end, usually on a quarterly basis based on operations, then you'll get a check of kind of dividends, if you will, from how the property's been operating. So when you say it's a passive investment, it's pretty passive.
So would you call that mailbox money?
Yeah, I think that's a good way of putting it. Yeah, mailbox money. That makes a lot of sense.
Do you like investing as a passive?
Yeah, investing as a passive investor is great, especially for somebody that's, say if they don't have a lot of time, but they have some capital invest and they're wanting to expand their portfolio and get some better returns than you can get, for example, as opposed to the stock market with maybe a little less risk. At least that's my opinion. Then it's super easy. It's great.
Now, at that period of time, did you think that you wanted to go from a passive investor to a lead investor?
Absolutely. Yeah. Actually, interestingly enough, going back to, the couple of guys who were looking at properties. So we were all kind of looking to be lead investors originally. And as we're going through that, that's when I'd met other investors. And I said, well, maybe starting out as a passive investor makes sense because I can get involved and learn more. And that'd make me better prepared to be a lead investor later on.
So in my analogies that people hear me say is that a passive investor in the relationship to passenger, a passive investor is like a passenger on an airplane. They're sitting in the back of the airplane, enjoying their Coke, their Diet Coke, and their nuts, and they're letting the lead investor, fly the airplane and taking off and landing. So wherever the pilot goes, the passengers go too. But to make the transition from being a passenger in the back of the airplane to the captain's position, sometimes people go through the first officer's position to learn a little bit and kind of emulate what the captain is going to be doing. So just kind of shadow the captain. So did you become a first officer, a co-captain on your next transaction?
So actually, the third transaction I did, so in between I did do another passive investment.
How big was that?
That one was 116 units. That was built in 1980 in Denton, Texas. So fairly close to Texas Women's University. So that was really a little bit nicer property, probably qualifies as maybe a B-, type property, nice property. There's a elementary school near there. And that one was just a nice clean deal, and got to understand another market a little bit better. It was a different group of investors, so getting to understand a different style and a different management company. So I learned a lot there. But then going to your question about the third deal. So I'm going back to in the very beginning. One of the guys that I was looking at some properties with, and we were he was looking and I was looking at, for our own deals. And one of the deals that he found, which interestingly enough, he found it on LoopNet. Mm-hmm. And he was looking to do that. He had quite a background in rehabbing and flipping houses, and he was really looking to do that deal on his own. And as he was going through the transaction, and working with Paul, realized that the bank was really going to require somebody that had some W-2 income. And so, we knew each other, and Paul knew both of us, and said, hey, this would be a great way to kind of combine my W-2 income, plus the experience that I had in the previous two deals with my business partner's experience with rehab, and he was going to, be the one to manage the rehab. And, we're kind of like-minded, got along, and so we thought that it would make a lot of sense to, kind of do a joint venture in there. And to your analogy of kind of being the co-pilot and given the opportunity to learn through that process, as I was looking to do my own deal, that seemed like it would make a lot of sense. And that deal, was a value add deal. So the first two, as I mentioned, were kind of yields. So they were kind of little cleaner properties, nice properties. So this one required recourse financing, so a bank loan, because it had a lot of deferred maintenance. There was a lot of issues with management as well as the physical side of it. So we kind of needed to cure some of those things.
Yeah, so tell me a little bit about this property. I mean, how old is the property? Did it have pitch or flat roofs, individual HVAC? Paint a picture of what this property looks like.
Sure. So it was a 1963 asset in South Irving, Texas. And so it consisted of two buildings. One of those buildings, it had individual ACs that were kind of in the wall. It's kind of like the wall unit, if you will. And then one of the buildings had a flat roof and it had a chiller system. So we kind of had both on the same property. And so when you looked at the property, it was, you could tell that there was a lot of deferred maintenance on the outside, things that kind of need to be cured. The parking lot was kind of broken up, but, didn't have any amenities. You just looked at it, you could tell that it was a little bit tired. Yep. And then on the interiors were in pretty bad shape. They were going to need quite a bit of work.
So I'm familiar with the asset. I think I have financed that property 4 times in the last 30 years or so, 4 or 5 times. So the group that owned the property was out of California, and it did look tired over a period of time. They kind of try to self-manage the asset at a distance, which never works out very well. It's a smaller property, so just like Alan said, it's not a big property, and the technology in 1963 of chiller or wall units was probably the highest and best technology at that period of time, which it is not today. So you're dealing with a couple functional problems with the asset itself, and so let's talk a little bit about how you guys worked through that. So you guys did a bank loan on that deal, so you acquired the property, and you had some rehab in that loan too. Do you remember how much rehab dollars you guys had?
Yes, we had $150,000 in the loan. And so what we did with that, a couple things. One was when we bought it, as mentioned, it was a little bit tired, didn't necessarily have the best reputation. And so, one of the things we wanted to do is really rebrand it. And so we changed the name entirely. In terms of outside, we fixed the outside. We did a brand new paint scheme on it, looked completely different. Got brand new signs, put in some nice pergolas. So kind of the stained cedar, pergolas, both up front and out back. And then out back, we put in kind of a backstop so the kids could play soccer, as well as put in a little dog park, some picnic tables, some grills. So we really freshened up the outside of it and rebranded it. And, everybody could tell, like, okay, something new and good's happening out here.
So you took the name of the property from Dan Villa to what's the new name you guys created?
It's Hacienda Serena.
Hacienda Serena.
Yes.
Okay. Why that name? Who picked that one out?
So Andrew actually came up with that name, business partner, and we talked about it, kind of throwing some names out, and we really thought that made a lot of sense because clientele of that area was primarily Hispanic.
Yep.
And we thought that would be a great name for that, and it kind of means serene house. And so when you looked at the paint scheme, it was kind of a lighter green with some trim, and so kind of a serene looking. And so we just thought that name was a great name.
So again, what type of rehab with $150,000 did you guys put into the property?
So the exterior items that we mentioned, and then on the interiors, and so we did a full rehab on the interior, combination of some wood look vinyl plank floors and carpet. And then, we did full paint in the kitchens. We upgraded some of the appliances. in terms of countertops. We resurfaced them.
So why do you and your client base like the vinyl plank flooring?
The vinyl plank flooring is a great product. Number one, it's relatively inexpensive. It's about, more or less the same price as putting in carpet. So in terms of all the different floor coverings you can pick, it's one of the cheapest. It looks great. It looks just like wood floors. It's glued down, and so you don't have that kind of tinny sound that you would have with a floating floor. And then it's really durable.
Yeah, durability is probably the biggest thing. Is that people that live in apartments in this B and C space love durable floors. As a landlord, it wears real well, so you don't have to. If you had carpets in there, you'd have to, on any type of a turn, you'd have to maybe replace the carpet, clean the carpet, dye the carpet. There's different high costs that are involved with that. And the durable vinyl plank flooring, if you do have a burn mark or so, you can kind of maybe patch it. And looks great. That patching cost is not very expensive at all. But the biggest thing for the tenants that why they absolutely love it is great to clean. So they just take a mop and they wipe right through it real quick. And they usually have throw rugs. And I tell you, it looks like real wood. I mean, sometimes you have to double look at it or triple look at it. Is this wood or is this vinyl plank flooring? Because it has a texture to it that looks just like wood. And when you feel it, it kind of gives you the impression that it is wood. Anything more that besides the things you mentioned that you did for rehab in the property?
Yeah, both in the kitchens and the bathrooms. So we replaced and upgraded kind of all the fixtures there, and just as I mentioned, kind of the full paint. So when you looked at it, I mean, they looked absolutely great.
So you took the property, and from the period of time that you guys owned it, do you remember what rents were at that period of time when you bought it to the period of time that you sold it, and what was the time frame? So there's a couple of questions in there.
Well, let's see. I have to do a little thinking there on that. But we owned it for 2.5 months. 2.5 years.
That was pretty quick.
Yeah, 2.5 years, actually from close to close, like to the day. It was kind of amazing that way. So that was the first question. Second, in terms of rents, so they were, as I recall, between I think $3.99 and $4.99, depending upon. And then when we sold it, we were I think $6.50 and $7.90.
Wow!
So we were able to. We had a completely different product, and the market really liked our product, and so we were to get that, and it was great.
In terms of a rate of return, not a number, but a rate of return. Any idea with your 2.5 years of investment, what was cash on cash return for you?
So being a value add deal, up front, not so much cash flow. It was about rehabbing it, leasing up, and pushing the rents. But before we sold it, after everything was kind of humming, we were about at 30% cash on cash. So
Wow.
we were quite happy with that.
So just on cash was 30%.
Right.
Wow! But your return on capital was a big number too, I'm sure.
Yeah, when it was all said and done, I think after we added it all up, and after you take out all the closing costs, and I had I think it was a 1% prepayment penalty on the loan. After you take all those costs out, at the end of the day, the money that went to the bank with the cash flow and the capital gain, it was about 150%.
Over 2.5 years.
Over 2.5 years.
That's pretty good. With at the end, 30% cash on cash. Why did you guys decide to sell it?
It's a really good question. So both of us were really looking to do, some larger deals. We had, a significant amount of capital in that because it was just the two of us in the transaction.
Sure.
And so, the market was such that it was a good time.
You executed your plan.
Yeah, absolutely.
Okay. So then in that position, you were the co-captain or the first officer, and now you felt you wanted to move over to the captain's chair. So tell me a little bit about what you did to get ready for the captain's chair. Were you out looking for properties in a specific area? Were you looking for another value added? Were you looking for a stabilized property? And so tell me a little bit how long it took you to find this property called Azel.
Yeah, it's a good question. So in the period of time while I was looking, which was probably at least a year and a half.
Okay.
So
Wow.
it was a good bit of time. What I was really looking for was 100 plus units, kind of hybrid, a little nicer property where the value add was more and the rents being below market, a little less than the deferred maintenance. So a little less than what Osseo Nasrena was, for example.
Sure.
And so, I was looking for that. I'm a pretty conservative guy, so I was look at the numbers, and I just didn't quite, find the deal that I was looking for. So interestingly enough, in that period of time, I actually was a guarantor on 2 other properties that was working on while I was looking. And so on this property, as I recall, I was looking at another property that I think was almost 100 units and seemed like it met the criteria. And I remember I was calling you up, Paul, to get your opinion on that property. And we were talking through it. We decided that probably wasn't the right one. But you mentioned that there was another one that was coming available, and it was probably one to take a look at. And so we talked about that, and it fit the profile in terms of.
So it was me that introduced you to this product?
It was you. Absolutely.
I love it. Go ahead.
Absolutely.
And so tell me a little bit about where's this property located at and how far is it away from your house?
Sure. This property is located in Azle, Texas, which from my house is about half an hour drive. So
And where's Azle?
Azle, for folks that are not familiar with the Dallas-Fort Worth Metroplex, so Dallas is on the east side and Fort Worth is on the west side. And so if you go north from Fort Worth, maybe 15 miles or so, there's a lake called Eagle Mountain Lake up there, and Azle is on the west side of Eagle Mountain Lake.
So huge growth going up that way too.
Absolutely, yeah. Everything seems to be going north that way.
So you've uncovered this property. What did you like about this deal?
So what I liked about the deal was primarily that the rents were 15+% below what the current market was. So we went on the ground and did a market survey of the market to see what the rents could be, and we saw that the current rents were, as mentioned, 15+% below market. As a matter of fact, on a dollar number, they were about $200 a unit below market.
Wow.
Yeah, so that was kind of the first check mark. Like, yeah, that sounds quite interesting. It was basically a 54-unit property built in 1985. Also on the property, there's a small commercial building that from time to time has been a restaurant and also been an small office building, insurance agency. So if you add it together, it's kind of operated as one kind of 55 units. Interestingly enough, one of the buildings in 2012 burned, and so it was rebuilt from the slab up in 2013. So that building was actually pretty new and up to code. One other thing that was interesting about it was why were rents, so far below market? Well, 2 things. So one is the property was 30 years old when we bought it, and 25 of those 30 years, there was an out-of-state couple out of California that owned the property. And interestingly enough, the property manager they had managed the property. He was on the property 28 of those 30 years.
Wow.
And so, the couple, they didn't come to the property too often, from what I understand. And they also weren't putting capital back into the property to keep it maintained. And so it had, a good bit of deferred maintenance, a few exterior items, but definitely on the interiors.
Yeah, she was pretty much using it as an ATM machine for a long period of time, not putting money back into the property itself, not upgrading the property. So the manager had a limited budget what to put into and upgrade the property. Unfortunately, he died and left her the property. I think at that period of time, after probably a year or two after he had died, they made a decision that they were going to sell the asset. What's interesting is I financed that deal probably about 8 or 9 years ago before he had died, of course. And that loan that we were paying off was a loan that I had done a long time ago. So did you have to rebrand that property? Did you have to change the name of the asset? How was the name in the marketplace?
So the name in the marketplace, it was okay. It was called Shady Creek Apartments when we got it. And if you looked at the reviews, kind of out there, they were kind of average. There wasn't really a whole lot out there. And so we kind of went back and forth of, kind of what should we do with rebranding. So we kind of ended up with a hybrid approach, if you will, because we really like the name Shady Creek because there was a creek that runs back in it and there's a lot of mature trees there. And so that name seemed to make a lot of sense. But what we did was we rebranded it Shady Creek Ranch.
Oh, okay.
Yeah, we thought that had a little...
ranch.
Yeah, that's right. A little flair to it. So we did that.
So I like the property. As Alan was saying, it's a newer property. The property was built in, say, 85 or so. It has great appeal, marketing itself right on a fairly busy highway. That's probably one of the biggest attractions as a landlord, that you have, 15 50,000 cars a day going back and forth, seeing your big sign, seeing your property, that your marketing budget, I guess, it probably goes down if the property was hidden in a cul-de-sac or in a residential area. So this was a good property for a potential tenant to find. So the property that you bought, and again, you just bought this property how long ago?
We bought it at the end of March 2016, so it's been a little over 7 months, 7.5 months.
Yeah. So the reason why I want to get Alan in today, because the property has launched off the pad, and this is going to be kind of a story about what type of a rehab he's put into the project and what type of a benefit he's gained from it. So when you acquired the property, you did a rehab loan also on the property, because you thought it was more of a stabilized property, but it really turned into a little bit larger value-added property when you actually took the deal over. So tell me a little bit about the amount of rehab that you originally looked to do on this property.
Sure, that's a great question. So when we first drove up to it, at first glance, it actually looked, pretty decent. And then, when you started walking a few units and, getting under the covers a little bit, said, okay, this, there's a little bit more to do here than at first glance. And so, as we went through due diligence and had all of our contractors out there and giving us bids and, figuring out what we wanted to do kind of from an upgrade standpoint, the net, we ended up with a rehab budget of $395,000 that we were able to get in the loan. Thanks, Paul. Appreciate that.
No problem.
And so, with that, there were several pieces of deferred maintenance that we needed to cure. So on the outside, we found several things, sewer repairs that we needed to take care of. The parking lot is concrete parking lot, which is great, but especially around the dumpstered area, that was kind of broken up and some things, so we need to take care of that. We had some roofing repairs to take care of. We had a few electrical repairs outside to take care of. When we bought it, the pool was completely green. I think it was probably more like a pond. There's probably a few frogs in there and things. And so, we weren't quite sure what that was going to be, but, we had to do a few repairs there, get that cleaned up, and everything was great. In terms of the lighting, kind of had the old style lighting and planned on putting the real nice new LED lighting, kind of brighten it up at night, make it look real nice. A few areas of siding that we needed to fix, but for the most part, the siding's in pretty decent shape, and it had been painted about 2 years ago, so the exterior paint was in good shape. We had to do quite a bit of fence work outside, so there's quite a few things to take care of from an exterior side. And then in the office, so it actually has a standalone office, which we liked. The office, it had basically 2 rooms that were kind of being used as an office, one that was being used as a shop, and in the back then there was the laundry room. And so one of the things that we wanted to do in terms of rebranding as our prospective residents would come in is that they would see a really nice updated office. And so we completely updated the office. As a matter of fact, what used to be the shop, we moved that to a couple of storage units we had on property. And so that shop is now our business center. And so when you walk in today compared to where it was, it's just completely night and day difference. And it really looks nice. And, if our residents want to get a cup of coffee, we have that for them. We have, a couple of computers for them. And
great.
So they can take care of that.
So, it's a very competitive market these days. Did you guys have to put hard money down at the beginning?
We did have to put some hard money down. In the end, I believe it was $50,000 in hard money we did on that one.
So in the order of events, you guys did an LOI. It was accepted. Then you did some physical due diligence yourself for your team to kind of figure out exactly what you had. And then that helps you kind of put together your rehab budget of what you wanted to have us put into the loan. Did you guys, after you did some physical due diligence, did you kind of retrade the deal at all? Were you able to get some concession off the sales price? And what was the reason for?
That's a great question. So, yes, when we were in due diligence, as mentioning, we first thought that, first look, it was like, okay, there's some things to do here. But as we went to due diligence, for example, as mentioned, all the sewer repairs we did, well, you can't see the sewer repairs.
Right.
And some of the roof repairs I do, couldn't see those. And some of the electrical repairs and things that just looking at it, you're not going to see. But then when you bring your professional contractors on site that are skilled in that and give you an actual bid of what it's going to take to remediate those things. So when we added that all up, it was a pretty good sized number. And so we did go back to the seller and ask for some help. with that. And so we were able to get, as I recall, it was about $78,000 additional
Yeah.
from that.
So that was just things that were going to be put back into the property, just a concession to help you pay for things that needed to be corrected, that had never been corrected, or at least not in the last 10 years, because money had not been put back into the property. And so when your physical due diligence crew found it, they brought it to your attention and you said, this doesn't look right. Let's go back to the seller, ask them for some help where we thought it was good, but it's really not.
Exactly.
So what was the biggest surprises after you guys bought the property?
Sure. Yeah, it's a great question. So, we knew we had to do some sewer repairs. And so, we definitely set aside a sizable amount to, take care of those things. And interestingly enough, before we were able to take care of one of them, it backed up as luck would have it on a Friday afternoon.
Of course.
And also as luck would have it, it was, backed up right along the frontage of the highway that you were mentioning. So it was a very visible repair when you've got, a big backhoe,
Yep.
Digging a huge, probably 25 foot by 6 foot by 6 foot deep hole.
Holy cow. That's a big backup.
That's a big backup. So it started out as a little bit smaller hole, but as they were getting in there, they found out that there was some kind of patchwork quilt and not the best repairs done before. So, for example, there was the 6-inch sewer that was, and this is the main sewer going into the city sewer, going down to a 4-inch pipe.
Oh boy.
And then there was another kind of temporary splice that, kind of is meant to be there, over the weekend, and who knows how long that was there. And then another break, and then actually one in the hole, I found out that there was some freshwater breaks because there were some patches that were done with some temporary splices there. And so what was probably started out to be a 6 by 6 foot hole ended up being that 25 by 6 foot hole, and also it was very visible. So we had our friends from the city come out and make sure that we were doing everything right and to code and everything like that. So that was an experience. So that repair ended up being a little bit bigger than we expected, but now it's all new and fixed and right and no problems.
How about water pressure? Any issues with water pressure at all?
Yeah. Actually, at the same time, while we were making those freshwater repairs, we kept on having the pipes pop with the joints, the new joints. And so ultimately, plumber had tested the pressure to the complex, and it was 119 PSI, which most fixtures and things are rated at 80 max. So this is very high pressure. And we were also noticing, kind of some other freshwater leaks and some leaks in some of the units. And it's like, well, that's what was causing that, was that high water pressure. And so in the end, through, some discussions with the city and showing that the water pressure was high, in the end, they lowered that water pressure.
Good. So the city didn't know you very well, but you knew that you had a plan to execute, and then you've executed your plan. And I know the city's been great probably to work with, since they've seen a tremendous amount of work on the property and having the property go in the right direction. So I think that's great. And then let's kind of talk a little bit about rent growth on that property. Talk a little bit about where you guys bought it at in terms of, 1 bedrooms and 2 bedrooms then, and where's it at now?
Sure.
After you've executed your plan for, 7 months or so.
Sure. So when we bought it, we had 1 bedroom, 1 bath, and those are renting between $525 and $550 a month. And then after we did a really nice interior upgrade, we've achieved new rents of $750 on that one.
Wow.
And so if you look at that, that's a delta of $200 to $225 a month. And what we're amazingly excited about that is that, when we had originally underwrote the deal, we were looking for $100 rent bump. And so we're more than double that. So we were pretty excited about that. And then the two ones were at $625 when we took over. We've achieved $825 there, so that's a $200 delta. The new asking rents there are $875, and so that's $250 delta. And then our last type is we have a 2 1.5 townhome, which actually those have been in the highest demand. So those were originally $625 to $650 a month. We've achieved to date $925 a month, so that's $275 to $300 a month bump.
Holy cow.
Yeah, it's super exciting.
Why do you think that is? Is it is it the market is so tight that people need housing, or is it because you think that the upgrades to the property have been so dynamic that it really can justify the higher rents? I know that you guys have turned over a couple of tenants or so to get there, because prior to that, people were not on leases, or what was the story with the leases?
Sure. Yeah, actually, when we took over, so I mentioned, we had the property manager there 28 years and out-of-state owners, and so there really wasn't a lot of tension there. So over time, there were a lot of things operationally that weren't done quite right, I think. So, when we showed up, basically, most folks were not on leases, and some of them had been there, 6 to 10 years, and, they were living in apartments that some of them needed some repairs, but, that's just kind of how they were. And then there was probably 25 to 30 different payment plans that were in place, a lot of cash. And so there's just a lot of things that, when you're following the letter of the law with fair housing, that those things don't fly. And so, one of the first things that we did, when I say we, I should mention that, so my property management company is Allied Property Management. And, I just can't say enough of how great of a partner that they've been through this entire process. And so, one of the first things that we did was, okay, we need to get everybody at least on a short-term lease, so we can get an application on everybody, and then make sure we've got the current Texas Apartment Association lease in place. Mm-hmm. And so that everything is done properly. And then, also that we need people to pay, check, money order, no cash. And so there's a lot of things operationally to clean up. And you can imagine when several people have been, operating in the same way for 6 to 10 years, and, kind of the new sheriff comes in town with all of his rules, which, by the way, aren't our rules. It's the state's rules, and we're just enforcing them. Then that was quite a challenge for the on-site team to work through. And they did a great job, doing as you might expect. There's a few people when you say, oh, you're going to start enforcing the rules. Well, I don't like rules. And so we had, a few residents elect to move on to someplace else.
In terms of a percentage, how many people have left?
So to date, over 7.5 months, we've probably, I would say at least 70%
have left.
Have left.
Okay.
So, we were planning on doing, full rehab on about 70% of the units. So you need to have units available to be able to rehab them. And so some of these residents electing to leave made those units available for us to renovate. And so we're actually planning on doing all of that over kind of a 14-month period. And it's probably going to end up being about 9 months.
Yeah.
Getting through that whole cycle.
But you've done most of the major rehab already. So you brought your occupancy down to 60 or 65%. Today, I think you were telling me that at the end of October, you're about 77% occupied.
Yep.
And probably by the end of November, you'll be at 80 to 85% occupancy. You're gradually moving the occupancy level up after you've been able to rehab these properties and put new tenants, higher quality tenants that like a patchwork quilt, not that type of a tenant, but more of a consistent background of the tenant itself. Tell me a little bit about it. You talked a little bit about partners on this type of a transaction. How many guarantors were in this deal with you, and how many limited partners did you guys have in this deal?
Sure. So there are 3 guarantors, myself being one of those, and then 2 others. And then outside of the 3 of us, then there's 3 limited partners, so a total of 6 partners in the deal. Mm-hmm. And through that, in order to get the deal closed, we needed to raise $650,000.
Okay. And you wanted to do all the rehab up front on the property instead of trying to take it out of cash flow. Imagine if you didn't have the money up front, or you just started to acquire the property without having any rehab dollars. What kind of a disaster would have that been?
That would be a disaster for sure, because some of these units, they just some of them were just totally down. But then even, many that people were living in for years, they were just in disrepair. And so there's a big difference between somebody that's, been there and willing to take care of it, as opposed to a new resident. You need to put in, $5,000 $5, $6, $7, $8,000, in rehab to, to fix everything as well as upgrade it to, a really nice place to live.
And your management team kind of had a pro forma on the front side of the deal, so you kind of knew when you guys acquired it and you executed your plan what you were going to be able to bring your rents to. Is that right?
Absolutely. Yeah, when we originally, had done the market survey, we thought there was, about a $200 rent bump. But when we underwrote the deal, we looked at it, more from 100 to 125. And, then when we got on the site, okay, let's, the proof is in the pudding. And so we took a look at that and took a little bit closer look at that and said, you know what? We really think that we can get 200 plus in rent bump. And so, with that, we took a look at the market and we upgraded a couple of the finishes. For example, one of the competing properties in the market was doing some granite countertops in the kitchen. And so we're like, okay, we're going to do that too. Because if we can get the, extra 100 plus rent bump, doing a granite countertop makes all the sense in the world.
Mm-hmm. So you guys have been in the property for 7.5, 8 months or so. What's the game plan? What's the future hold on this property for you guys?
Sure. The game plan from the beginning, and it really hasn't changed, is, so we bought it with the bank financing, and the idea was to rehab it, hit about 70% in the full rehab, and then do maybe some modular upgrades with some of the others as and when they come available. And so, the original plan was at the end of year 3, after all the rehab is done, after, we've pushed the rents, after things have been stabilized for some period of time, that we would look to refinance it, do a cash out refinance into some type of agency debt, either being, probably a Freddie Mac small balance loan or maybe even a Fannie Mae loan. I'd look to you, Paul, to tell me what would be the right.
Sure.
But a non-recourse loan. And so the idea was to pull our capital out and refinance it into that non-recourse debt and then keep it, long-term, assuming it was cash flowing really nicely, which we expected to. And at the same time, I said, okay, well, as and when we're making that decision, maybe we should take a look at what the market would bear, in terms of selling it, because we've really, in terms of the rent bumps, I mean, from a pro forma standpoint, we're killing it,
yeah.
Past our 5-year projection on the rents. And so we'll take a look at that.
Yeah, your value has just gone up tremendously by having, $200 plus a door times 54 doors plus, times 12 NOI, everything. I mean, that's going to be a big number, even if you wanted to sell the property anytime soon. Any funny stories on that property, whether it was the tenants or the rehab people or the city or anything you can think of? Well,
definitely the story I was telling earlier in terms of the sewer repair, the city showing up. And, we were, the new people in town, and they definitely wanted to make sure that, we were doing things properly. And so, I had a couple of them, show up over the weekend and, as the crew was working, just make sure we're getting it done. So they were quite engaged. And so we learned that, early on, and it's good that, we've developed a good relationship over time there. Also, in terms of rehab, we had a general contractor we were working with and done some units for us, and they did a good job. It's a really competitive market out there in terms of, getting labor, and we're trying to get some more folks out there to move a little faster with rehab. And actually, our management company, Allied, stepped up and they took over construction, and they just did a phenomenal job for us in terms of ramping up and getting the right people out there and turning the units and getting things done properly, as well as getting them leased up at the new rents. So that was great.
That's great. So the 3 things in properties these days, and it's always been, especially with value-added properties that can and will take longer than you think, is communicate, and communicate, because you got to set realistic expectations with the investors that have put their money into this transaction with you, the bank who's lent you the money, but also to the tenants, and get them an idea exactly. Since the new sheriff's in town, we're going to follow the right rules in the law and make sure everything gets done. Any last closing words at all, or perspective, talking to somebody that may be just starting out into the multifamily space? what do you think they should know?
That's a really good question. I mean, I would say one is when I look back, because I've been involved in multifamily now just over 4.5 years, and just in terms of planning for your future, planning for your retirement. As I mentioned, I was in the stock market a lot, and I lost big in the last 2 recessions, and I don't want to do that again. And so when I look at my net worth to date, or before I was in multifamily real estate, in which took me, say, 35 years to get to, 35, 36 years. And then since I've been involved in multifamily for the 4.5, I've been able to more than double my net worth in that time. And a lot of that, as we talked through, has been leveraging, expertise and time from other people. And so one of the things I would say is, because going back to my engineering background, I have a tendency sometimes to have a little analysis paralysis. And I think a lot of folks, have that. So they kind of go back and forth, should I do it? And I think their answer is yes, you should do it. So you should, decide to take action and just start doing it. And you'll start getting on the path.
That's great. If anybody wanted to get a hold of you, Alan, what's the best, say, email address that they could get a hold of you?
Sure. Probably the best email address is support@cksgroup.net.
One more time.
support@cksgroup.net.
That's perfect. Alan, thanks for spending some time with us in the podcast. You tell a great story, moving from the back of the airplane to the co-pilot to the role of the captain of the airplane. I think you'll always be the captain from now on. And you've done a tremendous job with the property over in Azle. Congratulations on that to you and your team of investors and management company. So that's great. Remember, if you need any additional information about kind of learning about multifamily financing, send us an email to info@oldcapitallending.com, info@oldcapitallending.com. That's a 15-page multifamily white paper report on kind of the roadmap to understanding about how financing works on apartments, a lot different from single family. Kind of learn through that report. If there's any questions, you can call us. But again, we appreciate your time in the podcast. Alan, thanks for spending some time with us, and we'll talk to you soon. Thanks.
Thanks, Paul.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.